Let's break down the idea of a trade surplus with a simple example. Understanding this concept is key to grasping how countries like Indonesia interact with the global economy, and why these numbers matter for everyday people. Imagine you run a market stall selling handmade wooden chairs. Every week, you put in hours of work, carefully crafting each piece. You manage to sell $500 worth of chairs to customers from all over town. That's your export value, the money you earn from selling your goods to others. But running your stall isn't free. You spend $300 on groceries to feed your family and on tools from other stalls to keep your business going. This $300 is your import value, the amount you spend buying goods and services from others. If you sell more than you buy, you have a surplus. In this case, you've earned $200 more than you spent. That extra money can be saved, reinvested, or used to grow your business. It's a sign that your stall is doing well. Now, let's scale this up to a country like Indonesia. Instead of one market stall, imagine thousands of businesses, factories, and farms all across the nation, each buying and selling with the world. Indonesia exports a wide range of goods: coal from its mines, palm oil from its plantations, and electronics from its factories. These products are shipped to countries around the globe, bringing in billions of dollars. At the same time, Indonesia needs to import things it doesn't produce enough of, like heavy machinery for its industries and fuel to power its cities and vehicles. These imports are essential for development and daily life. When Indonesia's exports are greater than its imports, it has a trade surplus. This means more money is flowing into the country than going out, strengthening the national economy. A trade surplus is often seen as a sign of economic strength and competitiveness. It shows that Indonesian products are in demand and that the country is earning more than it spends. A surplus means Indonesia earns more foreign currency, which helps stabilize the rupiah and build up financial reserves. These reserves can be used in times of crisis or to invest in the country's future. For months, Indonesia has consistently sold more to the world than it buys, boosting its economic health and giving the government more options for development and investment. But this balance is always shifting. It's influenced by global commodity prices, changing demand from other countries, and even unpredictable weather that can affect harvests and production. Economists and policymakers watch these numbers closely. Trade surplus and deficit figures are like a snapshot of the country's economic performance, helping guide important decisions. A big surplus is often cheered as a win, but a sudden drop can raise questions and concerns about what's changing in the economy. That's exactly what happened in Indonesia in October 2025. The numbers took a surprising turn. Let's find out why and what it means for the country's future. In economics, expectations matter a lot. When experts make predictions, markets and policymakers pay close attention. For October 2025, economists forecast Indonesia's trade surplus would reach $3.72 billion, reflecting hopes for continued strong export performance and stable imports. These forecasts are based on a mix of historical data, global trends, and local economic signals.
But the reality was quite different. The actual surplus came in at just $2.4 billion, a sharp drop from September's $4.34 billion. This gap between expectation and outcome caught many by surprise, raising questions about what changed so quickly in just 1 month.
This was Indonesia's smallest surplus in 6 months, signaling a noticeable slowdown in the country's trade momentum. The trend suggests that the economy is facing new headwinds, both at home and abroad, that are starting to weigh on its performance.
The main reason? Exports fell more than expected, dropping sharply as global demand softened. Imports also dipped, but not as much as exports, which meant the overall surplus shrank more than analysts had hoped.
Imagine your chair sales drop significantly, but your spending only falls a little. Your surplus or profit shrinks. That's what happened to Indonesia. Less money coming in, but costs didn't fall as quickly.
This isn't a crisis, but it's a warning sign. It shows that Indonesia's economy, while still resilient, isn't immune to changing global conditions or sudden shifts in demand.
The smaller surplus highlights vulnerabilities and challenges in Indonesia's economy, especially as it navigates a complex global environment. It's a signal that careful monitoring and adaptive strategies are needed.
It's a reminder that even strong economies are exposed to global shifts and disruptions. No country operates in isolation, and Indonesia is no exception.
The October surprise is a story of these challenges coming to the surface, forcing businesses and policymakers to rethink their strategies and prepare for more uncertainty ahead.
So what caused exports to fall so sharply? Was it a sudden drop in commodity prices, weaker demand from key trading partners, or something else entirely?
Let's dig into the details and uncover the factors behind this unexpected shift. Transition to next scene.
Indonesia's exports in October dropped 2.31% year-on-year, missing forecasts of growth.
The main culprits, coal and copper, Indonesia's star export commodities, saw both prices and shipment volumes fall.
When these key sectors stumble, the whole export picture suffers.
It's like a football team losing its top scorers. Overall performance drops.
This wasn't a collapse across all industries, but a targeted slump in a few critical sectors.
For resource-rich countries, global commodity swings can make or break the trade balance.
The October numbers show just how much Indonesia relies on coal and copper.
When demand or prices fall, the impact is immediate.
Next, let's see how China's slowdown played a role. Transition to next scene.
China is Indonesia's biggest customer for commodities like coal.
But in 2025, China's economy slowed. Factories produced less, construction cooled, and energy demand softened.
This meant less demand for Indonesian exports, especially coal.
Lower demand and prices from China hit Indonesia's export revenues hard.
It's a clear example of how closely Indonesia's fortunes are tied to China's economy.
Heavy reliance on one market is risky. When China slows, Indonesia feels it.
The October export dip is a direct result of this ripple effect.
Diversifying export markets is more important than ever.
Another factor behind October's weak exports? U.S. tariffs. These new trade barriers sent shockwaves through Indonesia's export sector, leaving many businesses scrambling to understand the full impact. For exporters, the announcement wasn't just a policy change. It was a ticking clock, counting down to a new reality that could reshape their bottom line.
The US announced new tariffs on Indonesian goods, effective August 2025. This move was widely covered in the media and sparked immediate concern among Indonesian exporters, who knew that higher tariffs would make their products less competitive in the American market. The news triggered urgent meetings and strategy sessions across the country.
Exporters rushed to ship goods before the tariffs hit, a strategy called front-loading. Factories ramped up production, and logistics teams worked overtime to get shipments out the door. The goal was clear: beat the deadline and avoid the extra costs.
This caused a surge in exports in June and July, but left fewer goods to ship in September and October. The shipping yards that were bustling in the summer months became noticeably quieter as autumn arrived, and the usual flow of goods slowed to a trickle.
October's numbers looked weak, partly because earlier months were artificially inflated. The data didn't reflect a sudden collapse in demand, but rather the after effects of exporters pulling future shipments forward to avoid the tariffs.
It's a classic case of trade policy distorting the data. When governments announce big changes, businesses often react in ways that create short-term spikes and dips, making it harder to see the real trends underneath.
The October dip wasn't just about falling demand. It was also payback for the pre-tariff export rush. The numbers tell a story of urgency, adaptation, and the unintended consequences of policy shifts.
Companies adapted quickly, but the after effects showed up in the numbers. Many firms had to adjust their production schedules and rethink their export strategies for the rest of the year, knowing that the market landscape had changed.
It's a reminder that global trade is shaped by both policy and strategy. Every decision, from government announcements to boardroom discussions, can ripple through the economy in unexpected ways.
The story doesn't end there. Domestic events also played a role. As Indonesia's exporters navigated the new landscape, they faced fresh challenges at home, setting the stage for the next chapter. Transition to next scene.
In September 2025, a mudflow disaster hit the Grasberg mine, one of the world's largest gold and copper mines.
Production halted, causing a sudden drop in copper exports.
The timing meant October's export numbers took a big hit.
Freeport Indonesia lowered its production targets for the rest of 2025 and 2026.
This wasn't just a short-term disruption, it's a long-term challenge for Indonesia's trade balance.
The Grasberg disaster is a stark reminder of how local events can have global economic consequences.
It's a supply shock that left a major hole in export revenues.
This was a key reason for October's smaller surplus.
While exports fell, imports also dipped in October 2025, down 1.15% year-on-year.
The drop was less than expected, but still notable.
Imports of consumer goods and raw materials fell, signaling softer domestic demand and a slowdown in manufacturing.
When households and factories cut back, imports naturally decline.
Lower raw material imports suggest factories are scaling back production, matching the weaker export outlook.
The fall in imports helped prevent the surplus from shrinking even more.
If imports had stayed high, the surplus could have vanished.
Both exports and imports falling points to a general cooling off in economic activity.
It's a period of adjustment as businesses and consumers react to uncertainty. Transition to next scene.
Despite October's weak numbers, Indonesia still posted a $2.4 billion surplus, a sign of underlying strength.
Indonesia's export economy is diverse. While coal and copper struggled, palm oil remained a strong performer. Palm oil exports are a cornerstone, with steady global demand.
Gold and jewelry exports also held up well, benefiting from global uncertainty.
These sectors provided a crucial buffer, keeping the trade surplus positive.
Indonesia's ability to weather shocks in one sector thanks to others is a key strength.
The October dip highlights the importance of having multiple export champions.
The overall trend for 2025 remains a large, healthy trade surplus.
Diversity is Indonesia's best defense against global volatility. Transition to final scene.
Trade isn't the only story. Indonesia's inflation rate slowed to 2.72% in November 2025, down from 2.86% in October.
This is within the central bank's target, giving policymakers room to maneuver.
Stable inflation means less pressure to raise interest rates, which is good for growth.
Core inflation also stayed steady, showing no hidden price pressures.
Despite the October trade dip, Indonesia's economy remains stable and resilient.
The smaller surplus was caused by weaker Chinese demand, US tariffs, and the Grasberg disaster.
But it's not a crisis. Strong sectors like palm oil and gold are picking up the slack.
The big picture is one of cautious optimism and managed stability.
Indonesia is navigating global challenges with resilience.
The outlook for the rest of the year remains positive.